tax as well as FEMA. And the whole idea here is to sort of give you a cross-dimensional approach or cross-dimensional perspective as to what all typically goes in a startup and how things are usually set up, and what are the pitfalls, what are the advantages, disadvantages of doing things in a particular manner. And this is based on my experience of dealing with more than 100 startups, dealing with at various scale and size, starting from Series A or small seed investment companies to large unicorns that we have been involved with over the years. And in terms of the flow, I would be covering the entity option. Should the startup be an LLP or a company? Then should it have a India headquarter or overseas headquarter? And what is particularly intriguing is if you have to set up an overseas structure, what we also call as externalization. What does it, to start with, what does it mean? And if you have to set up the structure, how do we go about? Because most of the structuring around startups typically come in if you have to go set up a structure overseas, which is more a norm of late with various startups typically migrating to Singapore. And there are also a bunch of startups which have gone and set up shop in the US, either for investor preference or if you got a US market. We will sort of walk you through that. And the related aspect is this round tripping, which is unfortunately not specifically defined but talked about quite a bit. And you also find a lot of compounding matters around this round tripping. And RBI has been particularly upset about this round tripping if you have set up a structure. We'll talk through how it means or what it entails, and how do we sort of get outside of this round tripping net. And then quickly we look at business models that are typically adopted by startups. If you are effectively in the tech space where the India entity sort of just does the tech development and the monetization of the product is happening outside of India. I intend to cover up to this. Time permitting, I've also put some outline of ESOPs. Nevertheless, the slides should be shared with you. If you're not able to cover that, at least you have some reference material around various incentive plans for startups, be it ESOP, ESPP, stock appreciation right, phantom right, and typical incentive schemes that are put in place. And I also try to capture or cover ESOPs, in particular, how we see it being devised or implemented across startups. For this background, I'll just move to the first piece in the entity setup. I've seen many cases where startups have been set up, or any new business that is there. The default choice would be to set it up as an LLP instead of a company, with a single minded focus that it's easy to administer, flexible. There's no dividend tax or dividend distribution tax, whichever way you call it. And in effect, it will be a single layer tax entity, LLP, and pretty much it's not governed under any stringent regulatory framework, like say a deposit rule or any sort of pricing issues that are there around Section 56 or of Companies Act, sorry, of Income Tax Act or allotment. Now, while LLP is an extremely good form of entity, the challenge or the downside of the LLP is all the flexibilities are seen as negative by the investors when they're making investment into an LLP. Reason being that there is no proper governance framework, there's not enough reporting or a compliance framework put in place. And also the many investors do not really understand how an LLP as a structure would sort of work in terms of investor rights, protections, etc. 99% of the cases, wherever you set up the startup as LLP, you may get only the angel or seed funding at max. And immediately thereafter, the company, the LLP will need to be converted into company if you were to raise funds. So this is a story pretty much in every single case. So whenever you're sort of discussing or setting up the structure for any of the founders. This is one important point to note. And then also looking at it, why company, despite its seemingly visible pitfalls, why investors sort of like it or go for it is essentially they understand it well in terms of structure. One sec, there's some issue. They understand the LLP structure very well, and it's a very mature form of entity. Enforcement of rights are pretty straightforward, or rather, it's much more easier than LLP. I would put it that way. And then also ROC or the reporting framework is very stringent in terms of be it a register of charges, allotment related compliances, rights are clearly defined. And then also you have this concept of liquidation preference. I will explain how it works a little later. And pretty much, as I mentioned, 99% of the companies are all, or of all startups are structured as companies. And at the same time, what is also sort of important to notice, if you've got a headquarters of your startup outside of India and you've got a development center in India, then it may not be that critical to have the business in India as a company. In those cases, we have generally seen even LLPs being adopted. So it all depends whether the investor has come into the LLP or is he sitting one level above the LLP, that is in an offshore holding company. So broadly, this is what it is. And only other point I would like to bring about in case of LLP is FDI is currently permitted under automatic route 100%, subject to that sector being allowed 100% under the automatic route for companies without any performance link condition. What do I mean by performance link condition is it should not have any conditions in relation to the operations. Like for instance, if I take a single brand sourcing entity or single brand trading entity, under FDI policy, 100% FDI is permitted under the automatic route. But there are certain conditions like there is a local sourcing norms that are applicable that a single brand trading entity should buy. Any of these conditions, once they are put in place, they are regarded or construed to be performance linked conditions, and therefore you're not allowed to put in an LLP structure. Same is the case even with real estate if you're looking at it, because of the 3-year lock-in and the related conditions, you cannot do an LLP. So that's broadly digressing a bit in terms of the regulatory or FDI framework pertaining to LLP. Broadly, the choice is simple. It has to be company if it's a holding company. The next question that typically comes up is, okay, now I've decided to set up the company. Now, should the company be set up in India as a main company, or should I have an overseas parent entity, which typically is a Singapore entity? And should the structure flow like I have a Singapore entity on top that has a wholly owned subsidiary in India? All the operations, etc., for that matter, are carried on majority or substantially in India. Singapore acts more like the holding company, which investors put in money. And from Singapore, we sort of route the money back into India time to time, as and when required for the purpose of operations. So, in effect, Singapore would be largely dormant in this particular example and undertakes fundraising activity. Over a period of time, depending on the business needs and substance creation perspective, companies end up putting employees overseas as well. That is more, it may not be in the near term, but that will be the ultimate goal for the structure to sort of succeed. Now, just looking at quickly pros and cons, and what you will also relate closely is a lot of it is written in papers also of late of multiple Indian companies leaving Indian domicile and setting up overseas. They're calling it something like a brain drain, not of individuals but of companies, where generally they leave India, go abroad. So the why to appreciate why this is being done quite generally, and many of the cases, founders are insisting that we set up the structure with an offshore parent right up front, rather than setting up in India and then trying to migrate the structure. Typically, if you set up a company in India, the pros or advantages are that there are less regulatory hurdles from a structure setup standpoint and from a promoter standpoint. However, and also there are no round tripping or any sort of other challenges. But on the flip side, if you look at it, there are comparatively lot of challenges. Be it operating tax costs would be higher. Then investors are not comfortable about the IP protection laws that are there. Significant compliance requirement. Every time you allot, you need to carry out a a registered value or valuation, filing of forms with the RBI, Companies Act. So all of it. So it's a heavy compliance burden that's been put on startups. And primarily from an investor standpoint, what is increasingly happening is many of them do not seem to be confident of enforcement of rights under the contract from an Indian legal framework. So that is the other reason. This is all linked to this ease of doing business, etc. So therefore, the idea for them would be to sort of have this rights encased in an overseas entity, which is governed under an overseas law, so that you have a better or a easier regime for enforcing your contracts. Just more quickly through what are the pros and cons of having an overseas headquarters. I'll not repeat it to the extent that it is pretty similar. Whatever were the cons of India structure will become the pros of overseas structure. What we have also noticed, it's more of a perception, I would think, that companies which are headquartered overseas tend to get a better valuation. Reason for this perception could be that there are many investors who are based in the US, etc., who do not have an mandate to or a permissibility to invest into an Indian company. Typically, they would have a mandate to invest in a US or another Singapore company for that matter. So therefore, once you have an offshore headquarters, your ability to reach out to investors, also a wider set of investors, is there. And with more choice available to raise funds, typically the natural consequence would be you may get a better valuation. So that's broadly the advantages of having a overseas headquarter. But there are certain negatives or disadvantages. One is it involves a fair amount of cost and efforts to set it up to start with, and more amount of costs and efforts if you have to sort of migrate an existing structure that's been set up with the India headquarter. Then also you have this round tripping risk, poem risk if you have turnover above 50 crores coming in. More than anything, what is happening world over with BEPS and all these other related changes coming in, the world is moving towards substance requirement more than effectively looking at the form of it. And by substance, what I mean is you need to necessarily have people of reasonable stature sitting outside India taking key commercial decisions, all of it. So that is one important requirement for the structure to sort of succeed. Gone are the days where you have a holding company with no employee. You just hold shares in an Indian company and everything is done out of India. Those sort of structures are becoming increasingly difficult to sort of substantiate or defend. With this, I'll move to the next slide. These are the typically used jurisdictions for setting up companies overseas. More often than not, we see at least some 70-80% of the companies going into Singapore. Balance at 20-25% of the companies going to US. Very low proportion going to UK, more so after Brexit and other things that happened. And we've rarely seen companies going to Netherlands or Ireland for that matter. Because generally US companies have subsidiaries in these countries, but they may not really have a holding company for startups in either Netherlands or Ireland for that matter. And why Singapore, why not other countries is it's a fairly well understood regulatory regime, been very stable, offers one of the lowest tax rates in the region, no withholding tax on dividend, all this fees for technical service, there is generally no withholding tax, all of it. So it's like a well-regulated, tax-friendly jurisdiction. US also is trying to do its bit by reducing the corporate tax rate to 21%, all of that. But Singapore wins the battle hands down in terms of complexity. And also, what happens is for startups, if you go set up in US or UK for that matter, to get a decent quality advice, it is very expensive. So how that sort of matters is for you to set up the structure and maintain it, it's going to cost you quite a bit. So therefore, the default choice seems to be Singapore, unless the company has a lot of business in the US and it has to have a customer facing team sitting in the US. In those cases, we have seen generally companies going to the US. And you can carry out actually a comparative analysis of these jurisdictions. And most of these large accounting firms have got tax summaries put out in for general viewing, where you will get a decent understanding of regulatory and tax framework for each of these countries. It's freely available, so that's how even if we have to sort of look at any jurisdictions, we carry out a desktop analysis. Ultimately, whatever analysis we sort of figure out is validated by a local tax expert or a jurisdictional tax expert, so that whatever analysis we have done, we don't get it wrong. So that's broadly the approach that we take while evaluating and setting up the structures. So till now, what we're seeing essentially is if I'm setting it up in India, should it be a company or should it be an LLP? Next piece is where to set up. Should it be in India or overseas? And in overseas, it was which country. Now, say the here on for next few slides, assuming the decision is to set it up as an overseas subsidiary, what we call as externalized structures. The discussion is going to be around how do we sort of set it up and what are the regulatory challenges or frameworks around it. The most simplest form would be all the individuals who are the founders will set up a foreign company, and the understanding is that the foreign company in turn will have an Indian company. So the structure would be something like this. There'll be Indian founders who will own shares in Singapore company. And I'm using Singapore instead of calling it overseas company just for the sake of simplicity. Say Indian founders own Singapore company. Singapore company in turn needs to have a subsidiary back in India for the purpose of operations. So this structure is not permissible because of round tripping, etc. I'll come to it in a minute. But largely, if individuals are sending the money, it has to go under liberalized remittance scheme. While you're permitted to remit up to $250,000 per person per year, the requirement under LRS and ODI regulations on a combined reading is that individuals cannot invest in foreign companies which have downstream subsidiaries, and this downstream subsidiary can be in India or overseas. All that it says is that overseas companies having Indian resident investment under LRS ODI route should be single layer operating company. So there should not be any subsidiary companies or anything below. The reason why RBI brought this is it was becoming pretty much unmanageable with Indians setting up companies overseas. That company will take a loan or anything basis guarantee given rightly wrongly from India, and that money is used to invest back into India, and it is sort of creating a structural challenge. And by Indians taking significant exposures through guarantees or debt, etc., which was sort of not being able to be monitored by RBI. And also, there was a lot of money laundering, all of it taking place. So, having all this in mind, they have put this condition quite strictly. Only thing that is now permitted is, say, if I want to make an investment in Google US, Google US has got a subsidiary in India by namesake Google India. Now the question is that is also technically round tripping. And what do I mean by round tripping is it is more like Indians buying shares in a foreign company. That foreign company in turn has a subsidiary back in India. So technically, if you see, if I buy 100 shares in Google, uh, US, Google US in turn has a subsidiary back in India. Technically, the structure is a round trip structure, but the exception to this rule of round tripping or not having this downstream subsidiary is that if you're making investment under portfolio investment scheme, then these conditions should not or will not apply. So otherwise, what happens is pretty much as Indians will not be allowed to invest in any overseas company, even if it is listed, like say Apple, Google, Netflix, whatever that could be. And the meaning of portfolio investment is not that clearly defined, but drawing various inference from various aspects, what we sort of come to is if you're an investor there, you should just be any other investor. You should not have any control rights over the entity, like being the CEO or director or anything. So as long as it can be established that you're not set up a joint venture, but it's more a minuscule investment that you have done and you do not enjoy any special rights. All those investments comes under portfolio investment route. Where this becomes very critical is two founders or two friends can we set up a company in Singapore and remit money in this portfolio investment route and at the same time claim that this downstream investment regulations or round trip problem does not apply to you. That particular thing is not possible. And the other way, having said this, all this where we are remitting money from India. The other route that is there is instead of remitting money from India, I can also get the shares in an offshore entity by way of a cashless ESOP. And what I mean by cashless ESOP is I'm not really remitting any money from India and the ESOPs are coming free. This as a via media or as a medium to pick up shares in a foreign company is permitted. I will take you through what are the challenges around it in terms of valuation, all of it, in a couple of slides time. So broadly, this is a framework for investment by individuals, and whatever is in bold is critical. These are the things you can't do or you can do, which is relevant or critical. Now, say if individuals cannot set up with whatever we discussed so far, then the next logical option would be what if I put up an entity in India, but can be a company or an LLP, and I will try to do an ODI into a Singapore company. Here, the structure would be something like this. There will be two founders in India. They will set up an India company or an LLP, and that particular LLP or the India company will invest into Singapore, which is a main startup company. And that Singapore company in turn will have a subsidiary back in India, which may be the delivery center. Now, while you can make overseas investment being an Indian party, what is not permitted here is that if Indian company makes investment in a Singapore company, that Singapore company cannot have a downstream subsidiary in India because that tantamounts to round tripping. And round tripping structurally here is there is India on top, then you have Singapore. Singapore in turn has India, and that is not what is not permitted, and you will require specific approval from the RBI. The timelines and other things I will discuss a little later. So broadly, this is what it is. Given this restrictions that are there in the investment route, what are the typically adopted routes for setting up the company? So generally adopted route is the gift route, where we have pretty much 99% of the companies being set up under overseas under this gift route. So what we typically do in a gift route is we get a non-resident relative friend, not typically staying outside of India. That particular individual or a group of individuals set up a company in Singapore, say, and they can put in money. It may be $1,000, $500, whatever that could be. And once the company is set up in Singapore, it sets up an Indian company. And once the India company is set up, the shares of the Singapore company can be gifted to the Indian residents. So in effect, you have this particular structure, which you can see below, where you have Indian residents holding shares in Singapore company by way of a gift. And thereafter, what effectively happens is you have the Singapore company already holding Indian company. So you have the structure set up properly. And then you have all these new investors coming in who will put money into the Singapore entity. So this is the structure that is usually set up. And from a tax standpoint, as long as you're doing the gift between specified relatives, there's no tax. If you're not relative within the meaning of section 56 to 10 and read with 7, you will have to pay tax at 30% plus plus on the value of the shares you got it as gift. That may not be much, because if you set up the company with $1,000 and it's get gifted to two people, there may not be really any tax because you have a 50,000 rupee limit per year. And as long as the shares that are gifted to you have a value less than $50,000, that is good enough. And for the purpose of gift, the value of the shares have to be done basis the methodology, which is in Rule 11 UA, which is asset minus liability. So pretty much for newly set up companies, your your asset minus liability will just be equal to the capital that's put in. You just may have to pay tax on it. And under FEMA, while there is a grayness around the gift structure, because the concern generally is that what RBI has not permitted you to make direct investment. Are you skirting the issue by doing this gift where you're sort of violating RBI's requirement of not individual not being able to remit money to set up? But while that grayness is there, there is also specific or a specific, not specific, rather a general permission that's available, that an Indian resident can pick up shares in a foreign company by way of gift. So we go under this general permission. Again, what I would like to caution you here is it may not be within the spirit of what RBI thinks is permissible, but the general practice is going through the gift route because there's no better option available. The other via media, or the second option that is available around this is for the if the founders have worked overseas, they retain some money overseas. A view is there that you can use that money to set up a company. Again, there are some specific restrictions around you using your overseas money to set up the company, even if you come back. That is seen as a better option compared to this gift route. Uh, then, if the startup is large, or if the founder is generally traveling, the other option also what we are seeing is where the founders become non-residents at least for a year. They sort of leave India, settle abroad for a year or two, whatever that could be. Set up the structure, everything, and once the structure is set up, they can come back to India. But the problem here is, in case of startups, many of them will be small, the first-time entrepreneurs. They may not really have the means or the sources of funds to go abroad, become non-resident, stay there, set up the company, and come back. So it becomes pretty much like a non-starter, which in all cases, like gift appears to be the most feasible route. The second option is, instead of doing gift, what to do is you can have the non-resident set up the company with say $110, whatever that could be, and that foreign company in turn sets up India company, and you have the Indian company hire the founder as an employee. And once you're employee of an Indian company which has a Singapore parent, you can always get ESOP in the parent company. Effectively, what happens is you set up the company today in Singapore. Singapore has India subsidiary. Founder joins employment of the India subsidiary. Thereafter, the India subsidiary floats a global ESOP policy or the global ESOP plan, pursuant to which the Indian founder becomes a shareholder in the overseas entity by way of an ESOP. While as an option it works, only thing here also is from a grayness or an optical point of view, you cannot get 99% ESOP in the company. It looks very ridiculous. So that is one thing where you're sort of skirting the issue. Same like gift it will be, because ESOP is generally understood like it's a small allocation out of the shares, and it's not like you own the entire 99 or 100% of the shares through ESOP. So that's the gray area that is there. Again, from a tax standpoint is, when you get ESOP, in case of gift, you're required to pay tax on asset minus liability. But if you get ESOP and exercise it, you need to pay tax basis the merchant banker valuation report. And typically, what happens is if you have done the structure immediately thereafter, if an investor comes in, the challenge there will be that what is the value of this particular ESOPs that you've gifted? Should I take the value of the shares as of the date of gift, or should I take the value of such shares after the investor has come in? If the value is taken after the investor has come in effect, what happens is there will be substantial amount of tax that will be payable by the founder. So that is a downside of doing this ESOP route, primarily around the valuation. Other challenges on the optics of it, like how can you get 99% of the shares by way of ESOP? So broadly, that is about how do you sort of set up the overseas entity. And the third option that is there is if you don't want to do any of it, you go to RBI and take a specific approval. While earlier approvals were unheard of late approvals are coming in, but it's a backbreaking exercise of follow-up for a period of 6 to 9 months. As long as you have the wherewithal to sort of sustain this approval process and go through it for a period of 6 to 9 months, then you should be able to sort of consider this approach as well. Now, in this particular till now, what we discussed is if I need to set up an offshore company, how do I set it up? Default option appears to be gift, followed by doing ESOP. Third one is this RB approval. And I also discussed about founder becoming non-resident or he using his overseas money to set up the company. So broadly, this is the universe of options available. There's nothing else available. So you will have to make a choice of these options as to how do you sort of set it up. I'll just move on. Once I've set up the structure in terms of boxes, which is like I have an Indian or Singapore company, which in turn has set up an Indian company. Now the question is, how do I sort of move the business from an Indian company to the new structure? What do I mean by this is, say, this is not a new greenfield structure that is being set up. Say I'm already a startup, I'm running my business in India. I want to externalize my business. And by externalization, I've already got this structure set up either by way of approval or gift or any other mode that could be. I've set up the boxes, which is I or individual founders are owning company in Singapore, which in turn has a company in India. Parallelly, we also have a company in India, which is old company or existing company, which is doing the business. The business of this existing Indian company needs to be moved to the new India company, which happens to be a subsidiary of Singapore. These are the options generally adopted for moving the business from one India company to another. Broadly, if you look at it, it is a share swap arrangement followed by slump sale, asset sale. Then you have this demerger. Option 4 is merger. And lastly, we have option 5, which is a cross-border merger, which is now permitted under the Companies Act. This moving to first option may not work in most of the cases. It works where there are a lot of existing non-resident shareholders in the existing India company. This is the existing India company, assuming there are a lot of non-resident shareholders. Effectively, what happens is this non-resident shareholders swap their shares into Singapore, and Singapore in turn allots its own shares to the non-resident shareholders. So in effect, what is happening is non-residents holding in India company that is there gets sold to Singapore company, and Singapore company in turn allots shares back. So this is permitted under FEMA, swap of shares overseas. There is no restriction or any sort of a challenge around it. And by doing this, in effect, what happens is we keep the India company business intact. Everything else moves in. And let's take an example. Like say the promoters were holding 40%, non-residents were holding 60%. Non-residents swap their shares in Singapore, wherein you have the 60% ownership in India company coming through this leg. Thereafter, what we do is we carry out a buyback of shares where the promoters or Indian founders holding in India company directly is sort of cut off. With that, in effect, what happens is whatever was the ownership of India company prior to the structure gets replicated in Singapore. and at the same time, Singapore company will end up holding 100% stake in India company. So there's a structure that is sort of done and implemented for fairly sizable startups. Now, the question that would come to your mind typically would be, swap of shares is taxable. Like, why will anybody do it? Because there's no exemption for swap, unlike a merger or a demerger. Yes, certainly it is taxable. It is taxable at the full fair value of the FMV. But where this typically works is if the structure investors are come in newly, and as soon as they've come in, if you want to switch the structure to a Singapore route or mode, it works in that particular case. Or else you may also have a case where the company has not done that well, and the value of investments have not gone up. There also you could do it. Third case that is there is you can also do this swap where the shareholders are treaty protected. What do I mean by that is they are entitled for an exemption under India Mauritius or India Singapore treaty. Key condition for taking this exemption is that the investment should have been made prior to 2017. So there are certain facts that go into choosing an option, but broadly these are the parameters that you need to sort of consider, and steps are what was outlined. So the generally setup structure or the adopted structure would be something like this. You set up a new structure, a resident, non-resident through one of the other route, set up a Singapore company. Singapore in turn sets up India company, new India company, I'll call it. Then once new India company is set up, the business of existing India company needs to be transferred to new India company. So this can be done by way of slump sale. This can be done by way of asset sale. And generally accepted and the prevailing views, as long as the Singapore company is not dictating the price of the sale, any transaction you do within India is outside of transfer pricing. So therefore, you should be able to do it at reasonably justified values, while you may not require a necessarily a DCF valuation, etc. But always this is a subject matter of debate with GAR coming in, because what happens is, say the book value of the assets may be 10 crore, but the company is raised funds at say 100 crore value. And the question is, when you're doing the slump sale, should you adopt a 10 crore value or a 100 crore value? If you adopt 10 crore, it is not free from risk. Always there's a challenge of some taxes being imposed through an attribution of a higher consideration. While there is no specific provision, this is more a risk that can come under GAR. So broadly, that's the structure. Hope this was clear. You set up a parallel structure and simply transition the business from existing India company to the new India company by way of slump sale, asset sale, or any other mode. And similar option to this is, I do not do any sale of business, but what I do is I sort of gradually transition the business and employees from the existing India company to the new India company. That is generally seen to be a lot more less risky sort of an approach. But again, you need to have the time, etc., to sort of go through it. So structure is very similar, except for that instead of moving the business from India company to new India company by way of slump sale or asset sale like the previous one, here I either merge or demerge India company with new India company. And by way of merger demerger, I'm able to sort of shift the business from India company to new India company in a tax free manner, because merger demerger, as all of you would be aware, is not liable to tax. Only tricky part here is how do you sort of discharge the consideration for merger demerger. Typically, we have adopted preferential structures where you can sort of cancel out the value later. That's generally the way it is done. But there are certain nuances to sort of take care, especially while you're determining the swap ratio. So this is a merger demerger way of transitioning the business from India company to new India company. Last of the options that I have put out, this is a cross-border merger that is possible, where all the companies, that is, there is a new India company there is a Singapore company, then there is this India company that is their existing India company. We enter into a scheme of arrangement where India company merges into Singapore company. At the same time, in as part of the scheme itself, moves its business to this new India company, which happens to be a subsidiary of Singapore company. This is a little complicated because foreign company merging into India company is not liable to tax, but the reverse where India company is merging with a foreign company could be or will be liable to tax. So therefore, as an option, while it's available, it may not be really feasible. And again, doing a merger, demerger into a foreign company always is going to be subject to a lot of risk from a process standpoint. This is broadly the way in which you sort of structure or set up an offshore structure for an Indian startup where you have overseas headquarters, which has India company, Indian subsidiary rather. And how do we sort of move the business from the current setup to the new setup? These were the 5 options that were there, which I sort of outlined or touched upon each of it. What I've tried to do here is not get into too much in depth of what happens in slum sale in terms of implications, everything, because that is more of a corporate restructuring matter. But here, the intent or the objective was to give you a flavor of what options are sort of adopted in general if you need to set up a structure for a startup. Next aspect, while I was talking so much about round tripping, I just put out certain structures to sort of walk you through whether it's a round trip structure or not. So historically, the view earlier, at least 3.5 years earlier, used to be that what is meant by round tripping is where I send $1 from India to Singapore, and the Singapore should send back the same dollar. Only then it was construed to be round tripping. As long as the money sent by India company into a foreign company is kept in a separate bank accounts and not invested back into India, the prevailing view at that point in time was there's no round tripping because money has not gone from India and come back into India in the same shape and form. Adopting this, many structures were set up where you didn't really route the money from India to overseas and overseas back to India by keeping in a separate bank account, etc. But RBI's view is that whether you send the money from India and get it back to India or no, that's a secondary matter. RBI is clear. As long as you have got India on top, Indian guy holding shares in a foreign company, and that foreign company in turn holds shares back in an Indian company. Whether the money is moved from India to foreign and foreign to India back, that they are not concerned or bothered about. Their point is simple. The structure has India company has foreign company, which in turn has or back to back has an India company. This is what is not permitted as per RBI, and they're issuing a lot of notices directing the companies for compounding, etc. Earlier, what was happening, at least up to 2 years ago, in general, these structures were not getting picked up because the reporting framework was a bit lax. Then RBI has actually changed the framework for ODI reporting. Now, Indian company or Indian party has made investment in a foreign company. It needs to file annual performance report. As part of that APR filing, what needs to be disclosed is if this foreign company has any interest back in an Indian company, it has to be specifically disclosed. And what is happening is wherever that disclosure is coming, RBI is actually picking it up, or AD Bank is picking it up. And then that is a trigger that is coming in, which earlier you could have sort of set up a structure like this and got away. No longer that is going to be possible, increasingly with all the scrutiny that is around this round tripping. It's broadly what I wanted to share in round tripping. Now, what are the likely challenges or the concerns of RBI is that if you make for investment in a foreign company as per the ODI regulations, it should be for bona fide business activity. It should not be for financial services where I routed the money and the same money has come back in. There also could be potential challenges around ECB regulations because I may take loan in a Singapore company and put it back into India. So that is sort of not permitted. Likewise, end-use norms also may be violated in case of round tripping. FDI, again, here it's Indian party who owns a foreign company, which in turn is making FDI into India. So that could be the other violation of law, if I can call it so. So these are typical illustrations for round tripping. Indian company or party holds foreign company in turn holds India company, not permitted. Same, okay, only thing here I would like to sorry compare and contrast is, as long as this Indian party is individual who has picked up the shares in foreign company through gift or through this ESOP route that we discussed, or he has picked up this company while he was a non-resident, all those things are fine. This round tripping is more where, to start with, money has gone out from India under LRS or ODI route, and then the structure has been set up. That is where the challenge is coming from. Same thing, next one, where Indians own a foreign company which also has a PE investor, and that foreign company has India company back. This is also a round trip structure. Here, Indian company is having, or Indian party is having an existing foreign company. If this existing foreign company in turn buys an Indian company, this is again not permissible. So this is what has happened in case of Snapdeal, because there are a lot of compounding orders available on RBI website. And if you see, the highest amount of penalty typically is levied for violation of round trip. Here, what happened was the Snapdeal was an Indian company. It bought this Free Charge company, which was a Singapore company. Free Charge Singapore in turn had a company back in India as Free Charge India. So effectively, what ended up happening was when Snapdeal bought Free Charge Singapore, yeah, the structure was net. There was Indian company which in turn held Singapore company. Singapore company in turn had an Indian company below. RBI basically told that this is a violation of FDI and ODI policy, and then they levied some 13-14 crores of penalty. You also find quite a few illustrations similar. One more is, I think, a cement cases there where Indian cement company bought an overseas cement company, which in turn had a subsidiary back in India. Even that particular matter, it was held as violative of FDI policy, and then compounding fine was levied. So this is broadly the discussion around round tripping. Next piece is, okay, we have set up the company. So far, what we have sort of looked at is where to have the holding company, how do we set up, how do we move the business, and then also the round trip aspect. Now the question is, okay, I've set up the business, everything is fine. Now how do I sort of have the business model? Typically, what is the intent of most of the startup companies is to keep the IP overseas. Now, the reason for keeping the IP overseas, generally they say that is a better protection of IP overseas. Many cases, investors also insist that you keep the IP overseas, because whenever there is a sale that happens, if most or all the IP is held outside of India, it is easier for them to sort of shift the IP from Singapore to, say, US or whichever country, which may not be possible if the IP is held in India, because any sale of IP you need to pay full tax, either as capital gains tax, short term, long term, as the case may be. Compared to that, if Singapore is selling the IP, generally you may get away without any capital gain tax in Singapore. One of the other reason why it sort of insisted that you keep IP outside India. And also the related aspect also is that if you keep IP outside India, overall you may ultimately monetize the IP from Singapore in this particular case, and that will result in a tax saving in the sense that you will be exposed to lower operating tax cost in Singapore. So broadly, this is the thought process of keeping the IP within Singapore or US for that matter. And if I want to have the ownership of IP in Singapore, the way it is typically done is India would enter into a cost plus arrangement with the Singapore company, where Indian company renders services on a cost plus basis. The generally adopted margin for cost plus services is generally between 16 to 18%. And in effect, what happens is India gets compensated for all the work done around the development of the IP, and Singapore company pays consideration back to India. And since Singapore company has made payment for the IP development, that is shown to be the owner of the IP. Having said this, what is effectively happening is while the structure used to be fine so far, of late with BEPS and substance requirements kicking in effect, what is happening is just because you have people outside of just because you have Singapore company pay for the development of IP, that is not seen to be sufficient enough. They are insisting that you need to have sufficient level of people or significant or people with significant experience who will be sort of be able to direct the development of IP, which effectively means that you need to have reasonable people in Singapore who can give directions for IP creation. If this does not happen, in effect, what ends up happening is whenever India is trying to pay royalty later, the department would effectively say that some portion of the IP is actually situated in India because India did the development work. Just because India got paid, that is not fair compensation because under this BEPS, what is happening is if a company or any parent pays for development of IP, they're just entitled for a monetary return or a financial return on the cost incurred. They're not really entitled for the ownership return. So it gets very challenging if you do not have substance. And basis all this, you're required to sort of have substance in Singapore. And again, Singapore company can render services to customers using the IP. The work of it also, the delivery of it, if required, can be sort of outsourced to India on a cost plus basis again. Many cases, what we have also seen is the startups having customers within India who have to be rendered services within India. And it doesn't typically make sense for Indian customer to say, I have a parent in Singapore, you make the payment to Singapore company. And Singapore company in turn remitting the money back to India. That sort of generally doesn't work from a commercial standpoint with the customers because generally they wouldn't want to take forex risk or hassle of remitting the money, taking 15 CSCB, all of that. So typically, it so happens that they always would Indian company would always want to contract with an Indian customer would want to contract with an Indian company. To make good this business, what we effectively do is we can the IP that's been developed and held by the Singapore company can be licensed back to India company. And as part of license, we need to put in place a royalty arrangement. And what the royalty arrangement typically says is on depending on what is the nature of service, it can be like particular percentage of the revenue of the India company can be paid back as royalty. Now, whenever you pay royalty from India, as most of you would be aware, there will be GST under reverse charge basis. Plus, there will also be withholding tax on the payment of royalty at 10.4% subject to treaty. Now, if you look at a startup, typically what happens is it will be first a loss-making company. And in a loss-making company, you're paying tax in India because you're a cost-plus company. Loss-making company, I mean, as a group, you may be loss-making, but still you're sort of required or forced to pay tax in India on a cost-plus basis. At the same time, if you also license the IP back into India, that there will be a withholding tax leakage because if Singapore is not profitable, it doesn't get credit of taxes withheld. And then also you will sort of jack up your GST credit in India. Given this, what we have generally seen or advised companies is to put in place a stop loss arrangement. What do I mean by stop loss arrangement is the preamble of the agreement would be such that Singapore is a parent of India. If India company incurs more losses, etc., Singapore in turn itself has to fund. So therefore, what the stop loss arrangement says is that till the time India is profitable, it need not pay royalty. That way, by putting the stop loss arrangement in place, what we are sort of able to arrest is GST leakage and also the withholding tax leakage. And once India is profitable, then you resume the royalty payment structure. Effectively, then you pay royalty, you attract a tax of withholding tax of 10%, you save tax of 25% roughly in India. Net net, there is a saving of 15% on the taxes on royalties paid from India to the overseas entity. So this is the way typically the business model gets set up for uh, IT companies which have a overseas parent. This is the contracting structure which I just broadly discussed. Singapore company will render services to customers outside of India. India company does the same for India customer, and then you have this IP license coming in from US or Singapore to India, and there will be royalty payment. All of that takes place. So the next section I would like to sort of focus on is what are the typical issues that we encounter in startups and how do we sort of go about, and also what happens in general in a startup fundraising, like what are the sort of rights the investors take and what each of those rights mean, because generally we may not really appreciate what a liquidation preference means, or for that matter what is a preemptive right, or what is clawback for promoter, all of those. What I'll do is in next 5-10 minutes walk you through the concepts, each of it, maybe a little legal in nature, but the idea here is to sort of put numbers into perspective and how effectively that clause or structure works. There's a fundraise process. I'll not take much time. Whenever a startup is trying to raise funds, first it'll figure out who the investors could be, reach out to them, and then there is a term sheet that gets executed, which is more the outline of the transaction or the valuation that is being done and the process, everything else associated with it. Then there'll be a diligence. After diligence, there will be documentation, which is the reps, warranties, everything. Negotiation and final wiring of the money, followed by, sorry, execution of the document, followed by funding, and then you have the closing formality. Simple, very logical. Just that it is more of you find the investor, then there will be a term sheet typically, then there is diligence time provided. Meanwhile, you also negotiate the documentation for the fundraise. Then the funding comes in. Then when the for the funding to happen, typically there will be a lot of condition precedents, etc., where you need to do. Most of it could sort of flow from the diligence report, where from either tax or legal perspective, a lot of issues could be highlighted, and all those will have to be sort of fixed before you sort of proceed. And this bit I will probably skip through, which is more in terms of what are the documents generally entered into in case of startups. It will be an NDA or a non-disclosure agreement, which comes in the very beginning, at the very beginning. Then it will be this non-competition or non-solicitation. What it means is non-solicitation is generally investors do not like a startup taking the offer that is given from one investor, go fishing or hunting in the market by holding on to the term sheet saying that I've got this offer, if you can better it, I'll take money from you. All of that is sort of covered in non-solicitation agreement or non-solicitation clauses in the term sheet. Then a few cases, what happens is there will also be IPs that will be held in individual names that sort of gets allocated or rather transferred from or assigned from individual to the company where the investor is coming in. Then you have this ESOP scheme, which we'll try and cover time permitting. Will not be able to spend much time on it. Then you have this term sheet or letter of intent or MOU that you sort of sign, followed by share subscription agreement and shareholders agreement. Subscription is for the investment. Shareholders agreement is once all the investors have come on board, who has what right, who has the right to appoint directors, all of it would be defined in the SHA. These are the rights typically given to investors. I'll just pick one by one, talk through in 30 seconds time. First one is a preemptive right. What it means in terms of preemptive right is before the shares are okay, if any funds you're trying to raise, the investors will have the right to subscribe to additional shares in the company at the same terms what is offered to the investor, such that their shares in the company will not get diluted. So that is what is meaning of preemptive right. This can be in two ways. One is before you sort of offer the shares to anybody, company wants to allot the shares to anybody, you should go to the investor. Or if you anyway want to proceed and allot shares to a third party, the investor also sort of gets a right to participate pro rata. Because what happens if you look at a cap table, there may be an investor today who is holding 20%. If I go and raise additional 20% equity or 25% equity in the company, whoever was holding 20% may become a 16 or a 15% shareholder. For him to stay at 20%, he will want to put in more money so that even after a new investor comes in, the existing investor can sort of maintain a stake at 20%. So that's the preemptive right. Then you got this right of first refusal. What it means is if any promoter wants to sell or exit, it has to be first offered to the investor. So that investor would want to have the right to buy out any existing shareholder, and he wouldn't really want a new investor or new person coming in without his approval. Next, we have got this tag along right. What do I mean by tag along right? Is say there are two shareholders A and B. A wants to sell his shares, and say B has a tag along right. What in effect means is whenever A is selling his share, B can sort of follow along with him and insist the buyer to buy the shares held by B as well at the same terms and rights, etc. So that it doesn't become a case where one party exits without giving the right to other party. That's the meaning of tag along right. Then you got drag along right. This is generally a very negative right where tag along is a positive right. What do we mean by drag along right is generally what the documents provide for us that the startup has to have an exit event, which is either it should do an IPO or it should sell out. If the sale is not happening, then the investors will grow very impatient because investors generally have a time span of 5 to 8 years to make the investment and get an exit. And typically, what happens is if, say, I'm a financial investor, I'm having 40% stake in the company. If I alone want to sell to a strategic investor, say I'm a pharma startup and I want to sell my company to a pharma company, like say Dr. Reddy as an example. For Dr. Reddy or any strategic buyer, they would want to pick up 100% shares in the company. They wouldn't really want to be a minority shareholder. So by this drag along right, what I'm able to do is I will sort of force the promoter to sell 100% of his shares along with me, such that whosoever buys the company gets to keep 100% control in the company, so that he has all the flexibility and he's not a financial investor. He becomes a full-fledged owner of the company. So that is what sort of drag along means, where I'm able to drag the promoters along and force them to sell. Then you got this put option, call option. I think is generally well understood. I probably don't get in there, where there is a right to sell or a right to buy, as the case may be. This liquidation preference is a really strong tool in every SHA that you will see or SSA that you will see. And it is there is a lot of varied practice around liquidation preference. I'll just give a simple example what this liquidation preference means. Say there are two shareholders in the company. I am an investor. Say I have put in $30 million and I am holding 30% stake in the company. And the promoter is holding 70% stake in the company. Let's leave aside ESOP, everything for the time being. So it's simple. I have put in $30 million and I'm holding 30% stake in the company. And promoter is holding 70% stake. Now, liquidation preference is defined as 1x plus pro rata in the balance, 1x liquidation preference plus pro rata participation in the balance. So this is the terms that are used. Now, simple math, company say gets sold at 100 million. Now, by applying 1x liquidation preference, what I end up doing is out of 100 to start with, I reduce 30 million, whatever is invested by the investor. So what do I mean by 1x liquidation preferences? Whatever amount investor has put in, he gets to first take a dip at the 100 million that comes in. So I take 100, from 100 I reduce 30 million. What I'll be left with now is 70 million. On 70, investor has a right to participate for 30% stake in cut in this balance 70 million. So therefore, he will get 30 million, 70 millions, 30%, which is 21 million. Here, if you look at it, investor ends up getting 51 million, which is 30 plus 21 million, out of the total 100 million, and the promoter makes only 49 million. While the stake was 70-30, the liquidation preference works in such a way that investor gets their capital first, and they also get to participate in the balance money. And there are various norms for this liquidation preference. I have seen many cases even 2x liquidation preference being put in place. If it is 2x liquidation preference, same example, investor gets to first pick up 30 million into 2, that is 60 million. The way the math will now work will be 100, I will reduce 60 million, which will go to investor. I left with 40. On 40, investor again has 30% say. That's the terms that is different. That is 12 million. Overall, out of 100 million sale, investor walks away with 72 million, and the promoter is left with 28 million. So that is the impact of this liquidation preference. Your shareholding doesn't mean anything if the company is not getting sold at a huge value. I have seen actually companies where promoters held 40%, but because of liquidation preference held by the investors, they end up getting zero. That bad, or that's how crucial this liquidation preference is. Then you have got this other rights, which are this affirmative rights. And what do I mean by affirmative rights? It's similar to veto. In veto, what happens? Any matter comes to me as an investor, I have the right or ability to block it. If I vote no, the matter won't go through. And the downside with the veto is that, say, the notice is sent to me, I have not checked my email for whatever reason, and the notice period for that veto has sort of elapsed. Then the company can go ahead and do whatever the matter was without necessarily waiting for my approval. So in veto, it is a negative vote. To overcome the situation where, say, the shareholder has not realized that mail has come or whatever has come, communication has come, instead of having veto, it is sort of structured affirmative right. What do I mean by affirmative right is, till the time I as an investor have given a specific approval in writing, the matter cannot go through. It's not that I need to only block, rather it will not even get initiated unless I sort of approve it. So that way, even if I missed anything, it's not that anything can ever go through. Then the company or anybody needs to follow up, get the matter approved, and only then it has to go through. Lastly, I've got this anti-dilution rights. What it means is, if I've say raised value, a company has raised investment, let's say $100 million in the current round. Later, if the company were to reduce the valuation and raise further money at 50 million, what effectively happens by applying this anti-dilution or down round protection rights? While I've participated at $100 million valuation in the earlier round, I end up getting free allocation. The way it works is that, had I come in and invested at 50 million, which is a second round valuation, which is a down round, whatever stake I would have picked up, same amount of stake I get to pick up in spite of me investing earlier at a $100 million valuation. It's again fairly draconian. If you look at it, in most of the cases, what is effectively happening is investor is protecting or enhancing his right, and the promoter is left to hold on to whatever balance is remaining. So these pretty much every single clause, whatever I put here, will be there in a SHA, and this is the ramification of each of it. And you also need to see how critical or crucial it will be. And in case of affirmative rights, it will be also saying that if the promoter or the founder proceeds without on any affirmative right matter without getting a specific consent of the investor, that will be event of default and even has an ability of the promoter being thrown out of the company. So that would be how strong the documentation. Then there are this promoter clawback. Possibly skip this. Then what are the other issues generally we encounter in case of startups? First one I would like to sort of talk about here is angel tax or the super premium tax. What is effectively happening is whenever I'm allotting shares, if there's a premium, then the premium needs to be substantiated by a valuation report from a merchant banker. If I'm not able to substantiate their value, in effect, the company will have to pay tax at 30% under Section 5627B. Most of the startup, this is what is happening because they get a notice. At least government has been quite helpful in bringing this relaxation for startups as long as you are uh, registered as a startup. And the other exception under 56 are if you're a fund, etc., registered, you sort of don't get to pay this particular tax as well. And there are a lot of other aspects I would sort of pick up reverse vesting and its implementation. What do I mean by reverse vesting is, say today we have two founders holding say 40% in the company, and you have the investor coming in and who holds the balance 20% in the company. Under this reverse vesting clause, in effect, what happens is if any of the founders were to quit earlier, their shares would be sort of cancelled. Let me take my example. I'm holding 40% shares in the company. I have a reverse vesting clause of 4 years, which means I need to work every year to pick up 10% shares in the company. If I leave the company, say after 3 years for whatever reason, my entitlement of the 40, I get to keep only 30, and the balance 10 has to be cancelled out. So that is the meaning of this reverse vesting. And how it gets implemented is we have to sort of do a buyback or push the shares into ESOP trust, etc. But this every pretty much every SHA will have this reverse vesting clause, typically over a 4 or a 5 year period. Just last 5 minutes, we'll just look at ESOPs and employee incentive plans. So most of the startup, not most, if not all the startups have generally an ESOP plan, because when startups are trying to hire senior talent or high cost talent, they won't be able to match the same amount of salary that is being made or paid by a large company. In order to compensate that, they end up giving an ESOP or a stock purchase plan, which is an ESPP, or you also have the sweat equity, etc. So generally, the way it is done is you give the shares pretty much at a low cost or a zero cost or face value for that matter. Employee needs to work with the company, and depending on his tenure or performance, the shares would get vested in him. In effect, he becomes a part owner of the company by earning these particular ESOPs. That's the general framework around allotment of ESOPs. Now, the differences here, I'll just walk you through quickly, is ESOP is where employees are given options today. Options are granted and which vest in the employee over a period of time. What do I mean by vest is where employee becomes owner of the or gets an ability to become owner of the shares, that is called as vesting. So generally what happens is, like say 100 ESOPs are given to me. In that 100 ESOPs, say the vesting schedule is 25% each year. I work for 1 year. Out of 100, 25 become my own shares, and if I can call it so crudely. Year 2 I work, I get another 25 shares. Year 3 I'll get total of 75 in aggregate. Year 4 is 100. And once it is vested, I have then the right to exercise and become the shareholder. So that is the event of exercise. That is how generally an ESOP works, where shares are given at the end, not at the beginning. ESPP is reverse, where shares are given right up front. where I have a right to pick up the shares right up front, and then they may put in some lock-in conditions, etc. Generally, we are not seeing ESPP given because employee pays tax today, and if you were to quit, there is no way to recoup the tax. So therefore, it's generally 99% of the cases it is ESOP. Sweat equity and ESPP is the same. RSU is more like ESOP itself, but it's more a US terminology, not so much so used or adopted in India. Then you also got this cash settled incentive plans. What do you mean by equity settled is ultimately the share employee is going to become a shareholder. If it is cash settled, employee won't become a shareholder. He only gets paid in terms of value. So in that cash settled, the types that are there are phantom stock, wherein I do not become owner of the share, but I get all the benefits as a shareholder, including dividend, possibly that what is defined. And ultimately, whenever I want to encash the phantom stock, I get paid full consideration from the company in cash. That is a phantom stock, which is in all purpose, it is like a share, but it is not a real or an actual share. That is phantom stock. Then you got this stock appreciation right, which is what it effectively means is say today the valuation of the company is say 100. Stock appreciation right is given to me with a base price of 100, and say it's a 3-year stock appreciation right. So what it effectively means is today I have a right to get paid in terms of whatever is appreciation from 100 and upwards. Today the price is 100. Say in 3 years time the company value, if it were to move from 100 to say 500, I being an SAR or a SAR holder, I will be entitled for a payment of 400 rupees, which is a differential between the base price and the price at the time of ascertainment of FMV. The delta I get paid in cash. And the last one, of course, is cash bonus, which all of us understand. It is given as a bonus. So the last section that is there is put how ESOPs, etc. work, all of this. I'll probably not take you through it. With this, I would like to conclude my bit of it and take any questions that you may have. Okay. I'm just looking at the questions. Some 7 of them are there. One is any implications under indirect transfer of shares and gift between non-relatives. So once it is gift, there is no tax on the donor of the share because it's exempt under section 47(3). But the challenge is more under section 56(2)(10) in the hands of recipient. And I'm assuming here indirect transfers where shares in a foreign company are getting gifted between two individuals, and that foreign company derives substantial value from India in that particular facts. Now, in case of indirect transfer, whether 56 applies or no, that's a debatable issue. General view is that shares in a foreign company are not deemed to be situated in India for any purpose other than capital gain. So therefore, the view that is generally there is there may not be any implications under section 56(2)(10). Again, it's a little aggressive. If you look at it in substance and intent of it, there is a risk of 56(2)(10) applying. Vartraj has a point. Will swap agreement require RBI approval? Answer is no. It's specifically permitted now under the automatic route. All that you need to do is instead of taking a CA valuation, it has to be a merchant banker valuation. As long as you're able to get a merchant banker valuation, it is fine. You can do it under automatic route. Earlier, any allotment of shares for a non-cash consideration required FIPB approval. At that point in time, you also required for swap required FIPB approval, but now it's all under automatic. Satyaki has a query. which is actually quite a few. Actually, if I have time, right? I can just walk through each of them. Next is in swap of shares, the sale consideration in the hands of individual would be FMV of earlier shares or the shares of the new company. I would answer it in a simple terms. Whenever you're exchanging, it has to be both values have to be the same. In crude sense, whichever is higher would be the amount that will be taxable. Samir Padalwar has a question like substance of round tripping coming into picture. I'm assuming the query is like why is round tripping seen as a violation or I'm not sure. Samir, if you can just clarify the question, that will help. I will pick it up a little later.
We'll take it later, Amit. I'll maybe allow Samir to speak and then maybe.
Perfect. Or if you want, you can speak also instead of me reading one by one, whichever way. Next is Kunath has a point. What is the rate of royalty that is permitted from an Indian company to pay to an overseas entity? Earlier, there was restrictions like you had a limit of 5% on domestic turnover for a manufacturing company and 8% on export sales. All of that has been now removed. It's a current account transaction with no limit. I have seen companies pay up to 60% royalty on software sales, etc. So there is no limit. All that you need to sort of look at is transfer pricing from a arm's length standpoint.
Amit, I have allowed Samir to speak, so maybe Samir can.
Sure.
Samir,
Hi,
if you
Samir.
can unmute and speak.
Can you hear me? Yeah, Amit, can you hear me?
Yes, yes.
Yeah,
Proceed.
Samir. Hi.
Yeah, Amit. No, we have discussed on the various options of structuring. In that options of structuring, let us say by the swap of shares. Okay, your Singapore company becomes the holding company automatically, as the shareholder of Indian companies gets the shareholding in in Singapore company, and the Indian company becomes the subsidiary. So
Yeah.
automatically that round tripping substance will come into picture, right?
It will come in, but the whole point here is uh, whether anybody in India picked up the shares in Singapore company by way of remittance from India. If no remittance from India has taken place, there cannot be round tripping. If you have remitted money from India, then only round tripping can come in place. So that was the point I was trying to make. If you get the shares in Singapore company by way of gift or ESOP, round tripping should not or will not apply.
And I have another question which I have mentioned here that if there is a structure is already in place and very by investing very little amount, no, there is a 25% shareholding has been created, and now this particular company which is based out of US acquires the new company in India. What
Mm-hmm.
happens?
A new company in India, it will acquire at what price?
It is at a very less price, like let us say at a par
Okay.
value only.
Par value, yeah, it's a newly set up company, it will buy at par value. Then you sort of need to move if it's a new structure, there's anyway no problem. If not, then you will have to sort of figure out a way to move the business from your existing structure to the new structure.
No, no. What I mean to say is that in the US, the company is already in existence. Okay. Now this US company, and when the company came into the existence, there is a LRS for let us say very less amount because
Okay.
there was no need of
Okay,
company
understand.
money funds. And now this particular company, which is there in US, acquires the company by no again acquires the company in India by acquiring the shareholding of the existing shareholders.
That's not permitted.
So what
You
do you
get
suggest to do now?
no, that's not so. You'll have to dismantle the current US structure and then set it up afresh and then do. You'll have to set up a new US summit. That's what it'll come down to net net. Because we have seen many cases, people set up companies overseas under LRS, and pretty much you are sort of stuck with it. There's no way out of it actually. Or other thing is you need to go get an approval from RBI, which is like a 6 to 9 month process.
So
Okay.
what is likely to get an approval? I'm asking too many questions, but very sorry
No,
for
no,
that.
no problem. You will have to sort of explain to RBI as to why this structure is essential to you. And
Mm-hmm.
as long as you're able to sort of substantiate that and persevere through the process, you should get an approval. At least off late, we have been getting approvals, pretty much like some 6, 7 approvals in a year off late. And that's only us, and then there'll be multiple other people also taking approval. So it's
Okay.
coming through, all that I can say.
Okay, fine.
Yeah. So next question from Satyaki is, what is a recent experience obtaining approval for startups under ATIAC? I've also not done it. I understand it's fairly challenging going to interministerial board, etc. And at least whomever we work with, they will not be profitable, or if they're profitable, they will cross the thresholds of being a startup. So one of the two, at least we don't have a client which is small and profitable. So that's why we're not sort of explored this before. So the next question is, anti-dilution clause would lead to 56(2)(10) implications for the investor. Answer is yes, but Satyaki, again, the problem is, or not the problem, rather, how do we sort of give shares to the investors in an anti-dilution case is itself a trick, not trick, rather a point to be solved. What we generally do is it will be this anti-dilution will kick in by way of change in the conversion ratio of the CCD or CCPS. What we effectively do is, so when you're allotting the shares today, FMV of the shares maybe say 100. You have allotted the share, not FMV, so you have allotted the shares at say 100, and the valuation report is obtained at say 60 rupees as an example. So whenever a down round takes place, you can always increase the conversion ratio of CCPS from 1:1, say to 1:1.6 in this particular case, whereas your net effective price doesn't go below 66 or 60 rupees, whatever that was there. If you want, you can have an offline chat on it, but as long as you're able to do it through change in conversion ratio, there should not be 56:10. Okay. So next is on cryptocurrency. So lot of many guys are buying cryptocurrencies while RBI is frowning upon it. But working through credit cards, etc. Because what is happening in general, what I have sort of understood is, you buy some goods on a particular platform overseas. First, want of a better example, say Amazon, and you cancel the order. The money has gone in through credit card, all legit. Money comes return or refund that is supposed to come back to you. That refund people are taking in Bitcoin into a wallet that is overseas. So effectively, they're using this proper looking trade channel to book stuff from India in an offshore marketplace, cancel and collect Bitcoin. That's how they're generally doing. Once it comes into your wallet, then pretty much you can use it whichever way. But RBI is against purchase of Bitcoins using credit cards, etc. Well, the Supreme Court has allowed banks to deal or participate in business with cryptocurrency providers. I think a blanket ban is expected to come sometime around March. Uh, Shaishvi has a point. How is phantom stock structured under Indian law? So there is no legal framework for phantom stock. And again, I think in one Mindtree case or something, they had even taken an informal guidance from the SEBI, asking that whether SEBI ESOP regulations apply for stock appreciation, right? SEBI told no, because as long as you're not allotting share, there is no challenge of it. It's more a contract that you're sort of executing. A board approval should sort of suffice. Next point from Ganesh is, in round tripping, when RBI sends the compounding notices, in your experience, is RBI fine with compounding only one, or else they ask to dismantle? Generally, what happens is, compounding can come only once the structure is regularized. So what, in my experience, I've seen is the notice comes to dismantle the structure. Then you go back to them, explain why you did all this structure. You obtain an approval regularizing the structure, wherein they will say that okay, whatever your setup is fine. Going forward, you follow 1, 2, 3, 4, 5 conditions that you cannot remit more money from India. All of that will come in. And they will also put one condition in that regularization order saying that approach for compounding. And then only approach for compounding, because compounding as a rule cannot be undertaken once when the violation is open. So therefore, first you close a violation through a specific permission of the RBI on the structure, and then RBI itself will direct you to go for compounding, and you run that compounding matter separately. That's how what I've seen. Samir has one more question. What happens if structure is already? I think this I've discussed already. Next is Ganesha's. If not dismantled, then once compounding. Yeah. So I think I've answered this also, Ganesh. So once compounding structure has been regularized and you paid the compounding fee, you can continue with it subject to whatever conditions RBI has put in the regularization letter. Swami, when I was speaking, I realized this same thing coming in. How do you sort of take care of requirement under GST law for free of cost service from related party? The argument that we are sort of building here is if I have stop loss agreement today, eventually it will be made up by a higher royalty rate at a later year. So therefore, that is one of the argument that can be built in saying that eventually when I pay royalty with stop loss, I may pay say 10% royalty. Had stop loss not been there, possibly I would have paid 6% royalty. That is one way to sort of substantiate it. But yeah, this is a risk that is there. Uh, uh, but also here it is more of reverse charge and not a forward charge risk. One other thing, I'm not a domain expert on GST, but what I understand from my colleagues is unless you're paid for, reverse charge can't come. And it's not a forward charge liability that can come in under transfer pricing. And also another thing that I gather is as long as credit is available, this pricing is not that much a concern under GST law. So both these aspects you can look at. And again, as I said, I'm no expert on GST. Samir, I'll skip to this is for options. It reads. I'm not sure what it is. We have discussed rather. One more is Indian company has subscribed shares of a foreign company through subscription. However, money has not been remitted. Will it be considered as ODI for the purpose of filing? It will be considered as ODI because you are showing as ownership of the shares. This is a standard thing which goes for compounding. And there are questions like, will I be circulating the presentation? Yes, I'll circulate the presentation. So this particular thing, it's a compounding thing where you have sort of shown in your books that you are an owner, but you are not really remitted. But for ODI purpose, etc., we handled one similar case where we had to file for ODI, and this entity has shut down also. Then we had to file ODI Part 4 and then go to RBI for compounding. Next is, can LRS remittance be done through credit card? My answer is no. Is it safe to go for regularizing the structure? Samir, that's the only option you got. What else you'll do? If we create mirror image, how to establish control between holding and subsidiary company? Ganesh, mirror image, I'm not clear what it means. Are we saying that I'll have parallel companies, one in India, one overseas, both having same ownership? That's the case. We need to have a shareholder agreement tying up the two together. That's how it needs to be done. So not holding subsidiary, rather it will be to sister companies. And generally, we have seen the SHA doing a cross-linking one to another, saying whoever is exiting one SHA in one company is also bound by the terms of the other SHA. So it's independent SHAs with the cross-linking that takes place. And then To bind the two SHS, there's also a framework agreement which says that all the parties, this particular shareholder is holding one company in India, one more company in US, and how both the companies work together is governed under a framework agreement, which is one level above the SHA.